All right, hey guys, let's go on ahead and review the Robinhood portfolio for the previous week. And it seems like on Friday, the portfolio was down 0.38%, so I did not perform well. And in the after hours, it has slowly recovered for a 0.6 return, $21.05. For the past week, I'm up 1%, so that's very good to see. For the past month, I am up 2%, $852. For the past 3 months, I am up 16%. So that is I'm very pleased to see how the portfolio has performed during these times. There is the pandemic is still very strong. There's a lot of stuff going on in the markets, and there's a lot of whispers about this stimulus plan. So that's pretty much what the market is looking forward to. They're hoping that our government can sort of send out a stimulus package to everyone. And if you guys remember or recall from the first stimulus package, it was around $1,200. So the market really liked that. They really like the government's sort of helping everybody out. And right now, my portfolio is doing well. So I hope that continues. For the past year, I'm up 13%. I do believe that is beating the S&P 500, and my all-time shows that I'm up 19%. Let's go ahead and review the stock portfolio. There have been minor changes. Apple is back into the portfolio, guys. It's sitting on $445 right now. Let's take a look at my position. My position is 25 shares for an average cost of $410. So why did I buy the stock? You guys know in the previous video, I had, what stock did I have in the previous video? I believe it was Google. I had Alphabet in the previous video. Both Apple and Google were trading at a 29 times earnings P/E ratio, but Apple, if you guys been following the news, Apple recently had an ER. They had an earnings report that came out, and they completely smashed expectations. And once they did that, the stock pretty much shot up like a shooting star. For the past month, it is up 16%, and the past 3 months, it is up 44%. So it's gained almost 50% in the past 3 months, and it really did surprise a lot of analysis. It surprised a lot of investors out there because there is a pandemic, and I think a lot of people were counting on the fact that Apple would not perform well, but instead they completely shattered. They obliterated their earnings report. They pretty much hit a home run on every account, and we pretty much bought right back into Apple, not simply because due to their earnings report, but they also announced a 4-to-1 stock split. So the CEO, Tim Cook, he wants more investors to invest in Apple, but unfortunately, maybe some investors do get discouraged due to the stock price. Apple is sitting at $445, but as soon as that earnings report came out and I saw how well they did, we immediately sold Google. And Alphabet did report on earnings not too long ago, but it wasn't at the scale of Apple. I think they may be down on revenue, but Apple continues to just perform solid here, and we pretty much bought the stock immediately after the earnings report. Normally, I would not do that, but I simply knew that this stock was going to go closer to $500 once they had all those announcements, and we rolled the momentum up to a $872 gain. So Apple is right back in our portfolio, and this stock has been very kind to us. We previously sold the company for a 100% gain, and now we are up once again another 8%. So I'm familiar with the company. I've held it for about a year and a half, and we just continue to bank money off of it. This is one of my favorite tech companies, and when the stock split happens, I do believe that the stock split is a 4-to-1 split ratio, so I will be getting not 400 shares. I will be getting 100 shares of the company. I will have 100 shares of one of my favorite stocks of all time. So definitely looking forward to having that position in Apple, and that's the reason why we bought back into Apple no matter what the price was, and we've been riding the momentum. It's been a really good ride. So let's take a review look at Jpmorgan. $99. I have an average cost of $90. So I went on ahead and rebought Jpmorgan Chase because I do believe that there's going to be a slight rotation out of the overvalued tech stocks, and we've been seeing that the jobs reports have been getting better. The economy is still in shambles, but I do believe all of the players who have been waiting on the sidelines to deploy some cash, they are going to start finding some value stocks. So we're going to see a rotation a big rotation soon, and it's not going to last all that long, in my opinion. But for a 97 value for Jpmorgan, that's definitely undervalued. I put some money in here. I previously owned the company. I bought it at $91. I sold it at $94. So bought at 91, sold at 94. We've been making money off this stock. Not much to say about them. They're a big bank. I do like the banks. The banks are still undervalued. They're still under pressure due to what's been going on in the world. But I'm happy to have a 10% stake in this company. I like the stock. So and they do pay a dividend. And we're going to, I'm already up $74, so that's very good to see. It's a strong company moving forward as far as diversifying our portfolio. Home Depot, $271. I have an average cost of $153. So this is really rocking it. It's just crushing it. This is one of the best performers in the portfolio thus far. Not counting Apple when it gained 100%. But this is at 77%, a 77% gain for a $2,372 total return. Absolutely killing it with Home Depot, one of the best growers on the market. Pay a good dividend, well-managed company. Hurricane season is right around the corner, so I can only foresee that this stock will continue to hit home runs. So it's going to 300 very soon. Not counting the fact that if the coronavirus gets as worse as it does get, then the stock will tank like it did back in March. The stock got all the way down to $152, so it did hit lows, and that's where I bought it. But hurricane season right around the corner. I just continue to kill it with Home Depot, and we are closing in on that 100% gain. After that, I'll probably reevaluate the company, and I might continue to hold on. It's been a great ride. It's been a great ride with this stock. So I'm pleased to see that Home Depot continues to do well. AbbVie, $92, dividend play coming up. I do like AbbVie dividends, and I do like the total return that I am up on this company, 41%. $1,359. My average cost is so low that we just continue to hold it and see what it does. It has been trending back here for the past week, down 2%, and the past month it is down 5%. Perhaps it is due thanks to that lawsuit that they were going through. Let me see here. Let me just read the news. AbbVie agrees to pay $24 million to resolve the Humira, California lawsuit. So that could be a possible reason why investors are taking profits. They're probably trying to sell at the top of the stock. The stock has hit heavy resistance around that $100 mark. So it gets up all the way to $100, and then I think we see a lot of trading action. It hits a resistance point, and the stock goes back down. So AbbVie is just it's a wonderful company, a really good grower. I also like Johnson & Johnson, but I don't even think Johnson & Johnson is needed at this point. Our average cost is so low. We're up 41%, and we're getting paid good dividends. Just the combination of those three alone can make this a fantastic stock to hold for the long term. So let's continue to our portfolio. There's one more symbol VOO, the Vanguard S&P 500 ETF, sitting at 307. I have 35 shares for average cost of $296. So I have a market value of $10,000. I put $10,000 in this ETF because it's really hard to beat the market, guys. Not everybody is going to win in this market. There's going to be losers. There have to be losers. For all the winners that we have, there are certainly losers in this market. And even the most famous investors will quote to buy the S&P 500. The S&P 500, is average. So you're going to pretty much expect a average return. For the past year is only up 15%, and the past 5 years is only up 59%. But in reality, a positive gain is still a positive gain at the end of the day, and that's not factoring all the reinvested dividends that you get. It is a great ETF for me, and considering my case, because my portfolio is so small, diversification going on. I know I have a bank, I have a technology stock, I have a discretionary, I have a healthcare, and then after that, the portfolio just doesn't have anything else. There's no consumer staple in here. There's no utility. I got rid of Duke Energy. I sold Duke Energy, and I pretty much sold Duke Energy to get some more money into Apple, because I just knew that the momentum will be very strong with the company after that earnings report. And we've been paid pretty well with Apple. We rode that momentum up, but we put $10,000 into the Vanguard S&P 500 ETF. It gives us plenty of diversification. It gives us something that we can just sit and wait and hold for a couple of years or so. And I'm already up $300, so it seems to be working. I'm just following the market. If the market pulls back, yes, I will pull back along with it, but that always seems to be the case with my individual stock picks. And I plan on making the portfolio at least 40% of ETFs. So just for diversification's sake, this is just a basket full of stocks, a high diversity on technology, healthcare, and I want to say banks. So that's pretty much what all of its diversification is allocated to in this ETF, but we are also have a watch list at the bottom. That does it for the portfolio, guys. I only have 5 positions right now, but we have some more things on the radar. We have Disney at 130, and I'm upset with not buying Disney at 115. Unfortunately, I sold out of Disney, and they had an earnings report. And the earnings report didn't smash expectations, but it was a lot better than what people thought it would be. And the stock shot up. So it shot up 10%. We did miss that ride, but I'm pretty confident that Disney, as long as this pandemic continues, I'm pretty confident that Disney will dip back into the teens. And that's pretty much what we're waiting on. We're waiting for this to get back into the teens so we can buy it at that $115, $116 mark. Get Disney into the portfolio because this is just a fantastic company. I need some streaming services for my portfolio because I do believe that streaming is like the next big thing. It's like the next generational approach when it comes to what's been going on in the world. I don't think that the coronavirus is going to be an issue that's solved easily. So there's going to be a lot of changes to people's lives. There's going to be a lot of streaming going on. There's going to be a lot of iPad buying, just people staying at home and finding things to do. So I think that's why I want Disney. And looking at Netflix is too pricey. Disney is Disney is on our radar. We want this company, so we're going to set some money aside for that. And I already mentioned that we are going to add some more ETFs into the portfolio to increase our diversification. So we have SPY. A little bit pricey here, but I keep forgetting that Robinhood now offers fractional shares. So that's pretty much what we're going to do for the portfolio. We're going to buy, if we have to buy fractional shares of SPY, I'm happy to do that. And I will do that once the market opens, and I will continue to fund the portfolio because that's actually it, guys. Disney and SPY are on our watch list, and that's what I'm going to be adding to the portfolio. But we have been sitting on this $35,000 mark for a while. There hasn't really been any sort of like money put into the portfolio. I've been sitting on a lot of cash because I'm trying to see what the market's going to do here. I'm trying to see if we can buy some stocks at low discounts, but I haven't been increasing my buying power at all, which is okay. But that's going to do it for the video, guys. Let's take a look at some more stats. I'm going to take a look at our stock notes here. So our stock notes are adjustments. We sold Google for Apple. We're riding the momentum with a previous 100% gain from a past sale. And pretty much we have upcoming plans to buy Disney. Disney's on the radar and invest 10% cash into SPY. So those are pretty much the outlines for the portfolio going forward. A lot of growth in the portfolio. We're still getting the dividends, but we're not getting the dividends at the level where I'm getting $100 a month on all that stuff. What I plan to do is get make a dividend portfolio in Webull because we did make a Webull account, but the Robinhood portfolio is going to be like my growth account. It's going to be a growth account. M1 Finance is going to be like it's our Roth IRA, so we don't get taxed there, and then Webull will be our dividend portfolio, so we can withdraw money and put into the Robinhood portfolio, or we can put that money back into my bank account. So that's going to be it, guys, for the video. I hope everyone has a great trading week, and I look forward to talking to you guys next time. Take care.